Hey guys, Akil Stokes here. Welcome back to another Weekend Trading Edge video, your weekly look around the markets and your weekly trading lesson as well, I guess you can say. If you guys are brand new, I'm a Forex trader, trading coach, one of the co-founders at tier1trading.com. And this is a video I try to do each and every week just to kind of help struggling traders, new traders, or even consistently profitable traders just stay on track and keep progressing in their journey. Now, I apologize for being a little bit late this week. Typically, this video comes out on Saturdays, but I've entered that busy part of my year again, probably from September to December. So if I'm a day late, just please forgive me if there is an odd weekend where I just can't get a video out to you. There's over 600 videos on this page. Don't be a meanie. These things are free. Don't complain. Just wait for the next video. But I'll try to get it to you each and every week. Now, in today's video, I want to talk to you a little bit about stop losses, and this stems from I guess a quote I put up, or a post I put up on social media earlier this week, and I'll go ahead and share it with you. I said, I see a lot of traders place their stop losses at a level that is based on how much they are willing to risk or lose. In my opinion, this is wrong. A stop loss for me has to be technically based. How much I'm willing to lose affects my position sizing, not the placement of my stop. Then I asked, what are your rules for stop loss? And the little infographic thing said, here are my two rules for stop loss, right? Placing a proper stop loss order means balancing two things. One, being in a position where your analysis tells you that your initial prediction is likely to be wrong. And two, giving the markets enough breathing room to fight before making a decision on direction. And what I mean by that is like being in a position where your analysis tells you that, or that you're wrong, is that, there should be a technical level on your chart where you say, hey, if this level is crossed or if this level is hit, then my prediction for what I think the market was likely to do is wrong, and I want to be out of the trade. However, you don't want to put your stop loss, in my opinion, right on that level. We know the market does tricky things. The market likes to poke and probe certain levels. Many of you guys have probably been stopped out by the spread, where the market doesn't actually hit your stop, but it comes a few pips before it, and the spread gets you. So you also want to have that balance of giving it a little bit more breathing room, or just enough breathing room for the market to kind of do its little tricks, so you don't get caught up in all of that. And in some cases, right, maybe we'll dig into this in this video, maybe we won't, but the market knows where kind of new traders, undereducated traders put their stop losses. There are some pretty obvious levels, and the market will actually kind of drive itself down to push those levels before pushing up, or vice versa. So you want to avoid those levels as well. But I got some interesting comments from this post. I did ask for people to share their rules, and there were some really good rules. There were some ones that were not so much. And I try not to make the habit of telling anyone that they're wrong. I believe that, in trading, there's no single strategy, there's no single technique. There is really no wrong or right. It's all about differences of opinions. And I trust that if you're a consistently profitable trader, if you have something that's rules based, if it's testable, verifiable, repeatable, it's been back tested, and it proves that it's profitable, who am I to tell you that it's wrong just because I don't agree with it? I'm a little bit harder with the tier 1 members, because I'm teaching them a very specific style, but in general, that's my philosophy. However, I'm not the same on that. I want to read you a comment I got from someone I really look up to, a trader named Adam Grimes. Much more than a trader. He's a musician. He's a culinary artist. Awesome dude. Awesome book called The Art and Science of Trading as well, or Art and Science of Technical Analysis, excuse me. Great book. Probably not for the very beginner trader, but if you're someone that has experience of technical analysis, I think it's a must read, in my opinion. But he chimed in on the post and said, "You're doing it right." I blushed a little bit. You're doing it right. No other way makes sense. And then adapt that position size to the stop size to get your monetary risk on the trade simple. So, again, there's no such thing as a wrong or a right way, but just saying. So with that being said, as we dig into the trades that are on my radar for today, and feel free if you have different ways of placing stops, or if you have different opinions on it, use that comment section below. I love reading different stuff. That's how I learn. Again, I'm not someone that's going to bash you and say, oh, you're an idiot. If my opinion doesn't agree with yours, I just may ask, hey, can you explain it? And if I learn something, it's a win-win. If you learn something from whatever conversation comes from underneath that comment, it's a win-win. I've learned a long time ago in trading, we can't take things personal. We can't start arguments. We should just always kind of be on this growth journey of hearing opinions and kind of, letting what makes sense filter in, or letting what is helpful filter in, and then filtering out anything that isn't helpful. We don't need to argue about it. There's no point in doing that in social media. We just put it to the side. But what I want to do in today's video is, as we look at a few opportunities, we're going to kind of focus on the concepts of stop losses, and I'm going to show you and tell you why on whatever specific opportunity we look at, I would place a stop loss in a very specific place. So let's dig into it. Before we do, make sure you do me a favor, support this video, hit that like button, share this on your social media outlets, and of course, if you're watching this and you're not subscribed, subscribe, do it. All right, we're going to start here on the Euro Aussie, and this is actually going to be my only Forex pair of the week to show you about. And Euro Aussie is coming back down to a previous level of structure. And one of the easiest ways to identify structure, we can get a lot of questions about how to identify them and whatnot, is just look at the ebbs and the flows of the market. So the same things we teach in Foundation 1, where we're just drawing out new structure high, outside return, new structure high, outside return. If you simply do that on your chart, you're going to see where levels overlap, right? If I just start right here at a random point and just draw a white line up and down and up and down and up and down and up and down and up and down, right? I know it's repetitive and boring and all this fun stuff, but you'll start to see common levels of interest. You look at some of the swing points in this white line, and then you just draw a horizontal line here. You'll see that price action has been at or around this level multiple times, right? We've got obviously a hit right here most recently. 1, 2, he spiked a little bit past it here, but 3, 4, 5, you can zoom out and find, right, 6, this area right here. What else do we have? A little bit above it, but again, this structure shelf right here. So don't underestimate the value of doing just the small stuff. I know it's boring, it's not fancy or sexy, but it gets the job done. Now, we're coming down to this previous level of structure, which makes me look for or anticipate a little bit of relief. So yes, price action can break through it. We never know what's going to happen, but this is going to be called a decision point in the market. So what I want to wait for price action to do is come to this level. I want to look for a signal on the chart that price is likely to hold. And then as a trader, I'm looking to catch a little bit of relief. So not a full-blown trend continuation, anything like that, but just a little pop like that. And that's kind of a counter trend way at approaching the markets. Someone said the other day, I think trend trading is the only way you can possibly make money. And it's, again, just going on earlier conversations, no point in even replying. Just push that type of nonsense to the side. You can trade many different ways. So we got structure, we got the RSI oversold. I want to go down to a lower time frame a little bit and just give you kind of an idea of where a conservative entry or a conservative target would be at. Do the same thing and draw out our ebbs and flows here, right? Shortcut it this time, boom, boom. Right, an easy target location would be a move back up above the $1.60 level. So right now we're trading at 159.40s. We can go a little bit deeper, probably to 159 even. Could be 100 pips of potential profit in that area. Now, going on our theme of stop losses, where do I want to put my stop loss? Do I just want to put it on how much I'm willing to risk, like monetarily speaking? Do I want to make it a random pip number? No, I want to put it at a location that I know I'm wrong. So the entire basis of getting long at this area would be a hold of this structure level. Therefore, if this level of structure is broken, my prediction changes, right? That whole IPDE if then thought syntax, right? If we violate this to the downside, then I no longer predict a move up. I predict a move lower, which means I no longer want to be in a trade going up because that goes against my new prediction. So when we're looking at stop loss placements, we want to be below this level because this is the level that's going to tell us that we're wrong. And again, we don't want to just be right on it like a pip below, right? We want to give it the market enough breathing room so it can come down here, maybe it does some little spiky action like over here, and just really allow it to really prove that we're wrong before being stopped out for any type of loss. Next, we're going to head over to the Dixie. This is the dollar index. This is a little bit of a follow-up. This is a cipher pattern. This is a cipher pattern with a little bit of continuation on it. We talked about this a few weeks ago. You got to be aware of these overlapping highs up here as far as any longer type of continuation. But the most recent move was a higher high, higher close over our most recent level of major structure. So you can make the case for shooting for extended targets on this as well. But we finally dove down into our zone, right? Our completion zone is going to be from our 786. That technically completes the cipher. down to our X leg. So this should be the area where if you're not long already, you should be looking to get long. Now, if the cipher pattern, very similar to what we just talked about with structure, the violation point for this pattern is going to be the X leg, right? If the X leg is violated, then the pattern is invalid. So knowing that, right, when you place a stop loss, right, I don't think it's necessarily safe to put it somewhere in here because that is still in the realm of completion. The cipher can complete anywhere within this zone. So when you put that stop loss on, you want to have it beyond the X leg because this is the area that's going to tell you that you're most likely wrong. Again, you never know. Sometimes the market stops you out and still rolls up, but the majority of the time you're going to, if that happens, you're going to be wrong. And again, as traders, we're just trading the probabilities here. So next we're going to head over to the NASDAQ. You can see over the last 4 days, we've had 3 indecision candles and an inside bar, so a lot of tight consolidation here. This is going to be a high and tight flag formation, so a potential breakout situation where the market has put in higher highs and then we've kind of just stalled and channeled and channeled and channeled and channeled. If you've been following this channel, speaking of channels, right, each and every week, you know how I feel about these situations where we can bracket it to the top, we can bracket it to the bottom. Whichever way the market breaks out in is the direction that we want to get involved in. And when we have a little bit of a bias, like a, long-term bullish trend, we can create a bias that says we're more likely to break out one way or the other. Now, again, with the stop loss, with this particular pattern, we know that we're going to be wrong if we create a new low. So it's not necessarily, you don't necessarily need a stop loss that's super far away, right? I think that's another thing that traders do is they give themselves too much risk. It's a delicate balance. We talked about making your stops too small and getting skunked out and tricked out of the market. Those stop hunters out there. Another flaw is making your target or your stop losses too big, where you lose too much, right? Again, it's finding that balance where you're giving the market enough room to breathe, but you're not too far away that your losses are going to affect your wins. So I don't necessarily think you need a loss down here. You just need a stop loss below these lows. Yes, this would still be a pullback opportunity, a trend continuation opportunity. If the market were to dive down like this, we'd still be looking for a bullish move. But at that point, you can just reset and take it. That's a completely different trade, right? The high and tight flag is one thing. The pullback trade is another thing. You don't necessarily want to combine them. So when you're trading, you want to remember what you're trading, the actual thing, right? There's the whole premise of the direction that you're trading and the overall intention, which in this case would be to get long, trend continuation. But then within that bigger scheme, there's kind of different elements that you attack. So a high and tight flag would be one way to attack it. A pullback trade would be another way to attack it. You don't necessarily want to blend those two things together, right? Trade the high and tight flag. If you get skunked out, you take a loss, you take your loss. Then you can reload for that pullback trade if you get another opportunity, and that's going to come with its own rules for stop losses. So, don't risk too much on a trade. Don't over risk what you need to on any given trade, I guess is what I'm trying to say here. All right, US oil, this is going to be next. This is one I shared on TradingView during the week. Did a few TradingView videos this week. This was shared with me by my buddy Nikki, Cipher Hunter, right? Potential cipher pattern here on oil up at 786, so that's going to be 71.54s. Same situation as we saw in the Dixie, where again, cipher completes in this zone, knowing that stop loss should be outside of that zone, but this is a potential bear cipher pattern where if we get to this level or this zone, depending on your rules, we should look for some bearish movement here. Speaking of the theme of cipher, this is another throwback from a few weeks ago. Gold's been taking its good old time to do anything, but gold still has the potential bearish cipher setting up. We're going to look something like this. Again, let's go and use the cipher tool. X to A to B, our high point right here, B to C, and then CD completion right here at our 786. And of course, our completion zone, as you should know by now, is from our 786 up to our X leg. Gold is also putting in a potential move. I don't have any interest in this level, but we're coming to test the B leg, which is a pretty powerful or significant level of structure. Now, the way that we rallied up there doesn't offer any profitability for me, so it's not anything that I would be interested in trading, but keep an eye on it on the lower time frame if you're a counter trend structure based trader. This is something that, just looking bigger picture, if we get some symmetrical movement, could turn into a head and shoulders as well, right? If we kind of look at what we have here, let me just get my highlighter tool out, right? We have a left shoulder right there, we've got a head, If we hold this level and bounce back, we may have a symmetrical right shoulder. This could be something that could be used as an entry reason if you're very aggressive with the right shoulder, especially depending on what happens here at the B leg. But as we, or if we, break this neckline, and we don't go up to the cipher, this could be a potential pullback trade in advance of the cipher, or if you're not a cipher pattern or trader, just a head and shoulders in general, and look for a retest of the highs here. So we're still a long ways out. We want to see that right shoulder develop first, but we'll keep an eye on this for a little bit more than just the cipher pattern.